From Washington to Beijing, the phone call mattered. On September 19th, Donald J. Trump and Chinese President Xi Jinping had spoke for the first time in months. Under the backdrop of escalating tariffs, export bans, and underperforming markets, the urgency was different on each side. Washington has sought political stage show. Beijing doubled down on stability. So the result was a fragile but very deliberate set of steps, frameworks, to manage rivalry without letting it spiral down out of control. Before the call, negotiators had drawn up three pillars. First are the tariffs. In Geneva, the US agreed to roll the duties down from a punishing 145% to around 30%. Beijing has also cut its tariffs from 125% to 10%. A 90-day truce was set, enough to calm markets and buy spaces for further talks. China has also suspended some export controls imposed in April, which is a goodwill move, while still keeping restrictions on rare earths and defense-linked materials. Second pillar is the rare earths. In London, Beijing has offered a green channel for the US companies to obtain the licenses for the civilian-use rare earth materials and magnets. The decision reassured the downstream industries in the US, but it also underscored China's role as an indispensable supplier to the global economy and as a prudent guardian of defense technologies. The third pillar is a TikTok. In Madrid last week, negotiators has crafted a framework to shift the US operations into American-led ownership. The ByteDance, which is a Chinese parent company, would keep a 19.9% stake. It's still the largest shareholder, but not in control anymore. Then there will be a US-dominated board, which will oversee the operations and store data on American soil. The algorithm, which is the most sensitive piece of this talk, remains to be unresolved. Beijing has signaled that it might license the technology, but never surrender it. Washington, in turn, has extended the divestiture deadline to December 2025 this year. So after the phone call, Trump claimed that China had approved the TikTok deal. For the US politics, that was the soundbite. Beijing's statement told another story. There was no approval, just a reminder that all arrangements must comply with Chinese law and follow the market principles. The phone call also produced a calendar. Two leaders agreed to meet at the APEC summit in South Korea this October. Trump also announced that he plans to visit China in early 2026. The deadlines now matter. Geneva, London, and Madrid, they cannot remain frameworks in limbo. They must be converted into the enforceable commitments and the texts. TikTok remains the test case. Trump has promised the very strict control, but strictness and how strict is undefined. Does it mean the full algorithm access or a licensing deal with safeguards? Beijing's ambiguity is its own leverage. It's the ability to calibrate permissions without conceding its national security rights. The real friction, though, lies in the legal and regulatory sphere. In Washington, there is a very absurd law called PFACA, which requires the full divestiture of Chinese ownership in the sensitive platforms. Any licensing model could be attacked in Congress as a loophole. For the US lawmakers, the optics matter more than nuances. In Beijing, the export control laws classify the recommendation algorithms as restricted technologies. So approving transfers is not just routine paperwork. The regulators in Beijing cannot be seen as setting control, even if the licensing arrangements keep the economic channels open from both sides. So now the verification is a missing piece. Which party will police the algorithm use? Would the US monitors be allowed inside a firm that is still partially owned by ByteDance, a Chinese company? Could Beijing demand reciprocal oversight to ensure that algorithms are not altered against its own interests? Without a credible enforcement, the frameworks risk collapsing. But with excessive enforcement, it will also risk being seen as intrusion. And that is why the APEC summit matters, because both sides now have to decide if the tariffs, which is currently at 30% and 10% respectively, will be reduced further, extended, or snapped back. The industry lobbies in the US are now pushing for more rare earths in Beijing's Green Channel, but the Chinese regulators are also weighing whether the expanded supply will dilute its own strategic leverage. Technology control also remains on the table. The Washington restricts the high-end AI chips and design software. Beijing hints at reciprocal licensing or the narrow carve-outs. If carve-outs appear, they could be framed as a pathway for the future broader access. And then there's energy and commodities, which adds to another level of complexity. Washington pressing China on Russian oil, then Beijing counteract on the drug issues. The disputes now move as a package. Above all, Beijing projects two messages at once. Sovereignty is non-negotiable, but stability is a responsibility. By pausing tariffs, easing the rare earth access, and keeping negotiation open, China is positioning itself as the actor that prevents dislocation, not the one driving it. Markets have taken notice. The technology stocks tied to advertising and social media have rallied. The EV and renewable energy, their equities edged higher, buoyed by the expectation that rare earth supply will hold. But investors know fragility still remains. The US lawmakers can still block the deals, and the Chinese regulators will not approve arrangements that dilute its own control. So the global signal is larger than TikTok or tariffs. If APEC produces a formal tax, the formal commitment, so it will be the first formal deal since the trade war began. For the global south, that matters a lot, because the managed rivalry between China and the United States will give the world more room to maneuver than unrestrained confrontation. Beijing's bet right now is that frameworks, however provisional, are better than shocks, so that order, not chaos, is still possible.